things that we already know about. So the Investment and Contract Readiness Fund, £10 million, grants of between 50 to 150,000 for social civil society organisations with high growth potential. The grants will be awarded only through registered supporters. The current registered supporters are locality, social finance, resonance, and the people from resonance not in this room but here today. And the fourth one is clearly so. So joint application between, I'm going to stop saying civil society organisations, social enterprises and their supporters to attract the grant. It's got to lead within 6-12 months to an investable proposition that is going to need at least £500,000, and they're looking for bigger. So part of this whole trend in the social finance market to, we've got to get bigger. It's this massive rush to scale. The Mutuals Fund is a £10 million fund to support the spin-out, mainly, of mutuals from the public sector. The Innovation Fund is a DWP looking at service transformation within the whole aegis of DWP work. And to the new ones that they've indicated are coming, they want to create a social incubator fund. I think that's just a fancy name for managed workspace plus business support, if some people are old-fashioned like me, but social incubator fund. And the Outcomes Fund has also been referred to as the Results Fund, I think. And this is something that Big Society Capital is developing. They've just put out a call to tender for somebody to manage a £15 million fund that will provide working capital to those social enterprises who manage to attract performance by results contracts. And finally, the venture crowd. So Nesta, the well-known, whatever they are, endowment fund and promoter of new ideas in the whole world of society, technology, and the arts, are heavy into social media. They're also heavy into the whole idea of crowdfunding. They've just published a paper on crowdfunding equity. I must admit, this worries me. And I've put a quote there, taken straight from it, which goes to the heart of my worries about this. I think there are public appeals to individual people to invest risk capital in things that they're claiming don't have to adhere to the strict accounting standards required of public companies. I think that we're getting into very dangerous territory if we start to encourage the private individuals to invest their risk money. That's why I like community shares, which my mate Jim Brown is talking about, because I think that there are high standards set in terms of community share issues, but also the underlying model means that actually you only invest in community shares if you believe in the underlying thing. You want to be a customer, you want that shop, you want that pub, you want that soccer team. It's not a get-rich-quick scheme. This is trying to take crowdfunding into equity and get rich quick. There is masses going on in the crowdfunding area. A new platform pops up almost every week, it seems to me. Space Hive is backed by Nesta. Crowdcube claimed it was a social enterprise, but actually, if you look at the fine print, the lawyers who were backing them have walked away from that claim. Buzz Bank is Michael Norton.
Can I interrupt? What is crowdfunding?
Sorry. Crowdfunding is using social media to appeal to people to invest in your organisation. It really came out, originally it was artists who used it to get backing to make films or that kind of thing. So it's
public appeal via social media.
Public appeal via social media. And then there's various new ones coming along all the time. And obviously, traditional fundraising has also to some extent moved to the social media. So you begin to ask the difference between what's the difference between a local community centre putting out an appeal for donations over the social media and these established platforms. So, in short from me, there is an awful lot of chatter going on. There's an awful lot of interest in this. I have a dark past in the City of London, and I work with a guy who's stayed in the city. I left in '87, he stayed there, he's just come out and now heads up social finance. And he rose to the very top of investment banking, and he used to do billion-dollar, initial public offerings and that kind of thing. And I saw him last week, and he said, they're the people behind the social investment bond. He said there's been more global interest in that £5 million social investment bond than there ever was in the £1 billion deals that I used to do in my conventional banking. So the ratio of chatter to deals is absolutely vast in the social finance market, which is why we're going to hear from Gary, who very quietly, month by month, does deals. Okay, Gary, over to you. Just while he's loading, if there's any questions on... Yeah?
What's the obstacle to tilting that balance between interest and deal flow in the social investment space? As you just saying, there's just ridiculously inverse proportion between people talking about social investment and actual deals happening. What's the obstacle?
There's a whole variety of obstacles, essentially in the investment readiness space, and there is still not enough people prepared to do the hard yards. There's a lot of people talking about it, but getting people investment ready is really expensive. The other thing that Gary's going to cover is that there's not enough early stage risk development capital.
Okay, as I say, I'm Gary Brown, used to be a bank manager, gave that up 4 years ago and working for Crowdfunding. I'll tell you a little bit about Crowdfunding just so you've got some context for the work that we do. We are a social enterprise ourselves. We're a company limited by guarantee, founded by locality amongst others. We have a revolving loan fund. We give money out to social enterprises, community groups, charities, and we get the money back in and then lend it back out again. We use European funding to good effect, and we've been going since about 1999, 2001 we incorporated. We've been lending for about 10 years. So we do this revolving loan fund. We have some equity, we do small scale equity, we won't take more than 10% shares in anything that we do, and generally speaking those investments are sort of sub £20,000, so fairly small scale stuff that we do. And we do some small grants in Yorkshire and Humber. We've got grants, maximum grant we do is £5,000. Nothing we do comes without a loan. So no matter what you take from us, whether it's grant or whether it's equity, it always comes with a loan. And we lend to social enterprise. Social enterprise at its furthest extreme, using business to combat a social problem, using the world of business. And at its extreme, you would get all your income from trade, and everybody who was working within the business would get paid a proper wage. But that's at its extreme. There's all points in between. And I don't think we deal with many pure social enterprises. They're always a hybrid of some sort or another. So, finance. Primarily what I'll talk about is debt finance, because that's what we're really involved with. And in order to get your head around debt finance, you really need to know what the stages are in terms of what kind of finance you can get. So early stage stuff, the risk capital that you talked about, the high risk stuff, the pre-trading, where you're still testing out your model, is the seed capital bit, concept stage. Very difficult to get money for that purpose. Generally speaking, if you wanted to start up a conventional business, this is the stage where you put your hand in your own pocket, go out there, buy a ladder, buy a bucket, and become a window cleaner. That's the kind of stage that this is at. It's very different in our world, in the world of social enterprise and community finance, because it's very rare that you can put your own hand in your pocket and put the money in. Most of the people have to go cap in hand somewhere else to get that risk capital. So this is a stage where you get very little involvement with banks or other traditional lenders. Startup, usually the stage where you've got your model, you know where you're going, you know what you want to do, now you just need the funding to get started. So that's that stage. No track record, very difficult to get funding from people at that stage. Still regarded as high risk, but not as high a risk as when you're not trading. Early stage, you've probably been trading for a little while, a year, maybe 3 years maximum, in that early stages. People starting to establish a track record, ears starting to prick up, people will listen when you talk to them about the kind of business that you're doing, people will provide more money, less risky for a lender at this point, because you've got a little bit of a track record, you can see what you've done, you've tried a few things, you've failed at a few things have worked, people start to get interested. This is a stage where some banks will get involved, but usually when a bank gets involved, when I used to do it, you hang the debt around someone's neck or you pin it to an asset. And if you can't hang it around someone's neck or pin it to an asset, they don't get involved. So still regarded as high risk. It's where the CDFIs come in. Keyfund is a CDFI, we're a specialist CDFI to this sector. And then there's the development stage where you've got a bit of a track record, you've done what you want to do, but now you want to go to the next level. You want to expand the business, perhaps open another unit, or compete for bigger contracts. At that stage, generally you can get funding from banks because you may have the critical mass within your balance sheet to allow them to lend into that balance sheet. It's got some cash in there, or you may have a book of debt, a debtor book. Your invoices might be sufficient to allow people to lend into it. So at that stage it becomes easier. But also it's the stage where you might go back to the start and start looking at people investing money in the business because now they can see something tangible for their investment. So those are the basic stages, as I say, from very high risk from pre-start through to the less risky at the other end. In terms of lenders and where they sit, the thing you have to get into your head is that High Street Bank is a low risk lender. They talk about levels of risk, but every risk they take is a low risk lend, mainly because of this thing about hanging it around the neck of an individual or group of individuals or pinning it to an asset. So most high street banks are low risk lenders. So in that scenario, they're only really looking at the tail of where they can lend. And then the national CDFIs, the Triodos, Unity, Charity Bank, they are still banks. So what they tend to do is quite formulaic in the way that they approach lending. They will lend into an asset at a percentage of the value. So they'll lend 70% loan to value, 60% loan to value. They won't lend 100% or generally won't. And usually we'll look at something where the requirement is £50,000 to £100,000 and beyond. Don't really get involved with startups to any great extent, but usually it's 50,000 and above where they enter the marketplace. Keyfund, as I say, is a CDFI. We get involved at the high risk stage. We will get there at the very beginning of the idea. If we like what's being proposed, if we think it's got social value and could make a difference, then we will get involved and employ patient models, and we will work with people to see how it might be done. There are some other people in the space, but again, there are very few competitors for Keyfund. When we're out and about, there are very few people who do what we do, because the bigger people want the bigger investments, the big splash stuff. So the medium to high risk lenders in this sphere tend to look at quite big projects. So the easiest way to get your head around this is for them to just talk through examples of the things that we've done. I'll start here at Hebden Bridge. Hebden Bridge Town Hall, that's the architect's drawing of what it will look like when all the scaffolding comes down and the painting's been finished and everything else. £3.2 million project, I believe. And there was about £1.2 million worth of ERDF money on the table, but ERDF will not fund a contingency. And in a build of this size, you have to have a contingency. Now, whilst they've been fairly generous in the costings, they didn't have the money for a £150,000 contingency fund for cost overruns. But ERDF wouldn't release the money unless they could confirm that they had the £150,000. So what we did at Keyfund is we provided them with a letter that said we would give you the £150,000 by way of loan, and that was an open letter for 2 years, which they could draw down the money at any stage. To date, they haven't needed it. We may be doing a little bit of funding to fund some of the timing difficulties in getting the money in. But that triggered the release of the £1.2 million funding. So Keyfund stepped in, we didn't part with any money, but the Hebden Bridge Town Hall project could go ahead because the RDF would sign the paper. So Barlane Studios, a different setup here because that was an asset transfer, it was a company limited by guarantee, but a registered charity. Barlane Studios is just a small company limited by guarantee in York. It's an art studio, York University, York St John. Students graduating fine art, design, but all have to leave the city because there's then nowhere to work. There are no art studios or no sort of incubator art studios, nowhere in York for people to do internships. So set up Barlane Studios, company limited by guarantee, 2 guys just set it up, working with York St John, working with Science City York. The studios, there was a cafeteria in there was a gallery, and the studios, they've got some of the biggest screen printing facilities in the whole of Yorkshire, in fact in the whole of North of England. It's been so popular in terms of gallery space, they've had to combine the gallery and the cafeteria now, so it's now one space as opposed to 2. They've divided up into more units, they've opened a shop, because again it's like, there's like a pop-up shop so the students can sell their goods in the shop, and it's become such a hub that they're now working with York Council on a bigger project, a public-private sort of venture where they're persuading someone to buy a bigger unit and then rent it back on a peppercorn basis to a group from Barlane Studios to do a much bigger version of this in York. And again, we've been involved in both those. We're at 30,000 for this one to get it off the ground as a start-up. The other one, we've put a little bit of money in to in the feasibility stage, just to see whether we can get this big project off the ground. Just to show that there are lots of different models around. Get Cycling is a community interest company limited by shares. Community interest companies limited by shares tend to get a bad press. People tend to think they're not social enterprises because people are, in this case it's a husband and wife team. Husband and wife put their own money into this thing as a community interest company. But as a community interest company, if you put £100 in and it makes £1 million worth of profit, your maximum dividend is 20 quid because it's 20% of the amount of your investment. You can pay out 35% of the profit as a dividend, but only up to the value of 20% of your shareholding. So if you put 100 quid into this, your maximum dividend is ever only going to be 20 quid. People talk about social impact bonds. I think that a community interest company limited by shares works at the same level. You can put a big amount of money in as a wedge, you've got shares in it, the financial reward is small, but the social reward is big. And you can use this at a much smaller level to do exactly the same thing as a social impact fund. Pudswell, if you saw the thing earlier, we were involved in that. I won't go on about it. Big share issue, was floundering. Keyfund stepped in, bought £20,000 worth of shares, tipped it over the top in terms of what it needed to do the project. The project was able to go ahead. Library, doctor's practice in there a couple of days a week. Little Red Doors, the community shop at Plunkett's open, smallest one in the country. But as I say, if we hadn't have been involved from the outset of that, working with them through the community shares programme, it might have failed at the final hurdle. Also on the screen earlier, you saw Slowick,
Slower, I think.
Green Valley Grocer, again. And these were on the telly the other week, weren't they? Well, indirectly they're wrong, because the handmade bakery was, I believe, was in the back room of the Green Valley Grocer. And the Green Valley Grocer operates in an area of market failure. So the local shop closed, or was on the throes of closing, had failed. Community buys it, it's now thriving. They put the bakery at the back, the bakery's thriving. The two of them together, because they're both I was going to say, because they're so successful, the bakeries had to move out. A, the shop wanted more space, and B, the bakery needed more room as well. So now you've got two businesses, that whereas previously there was
a need to take cash, we don't take cards.
Yeah. Well, it can come. I know how they can get cards if they're interested. That's another story. So again, another area of market failure, but where people with a bit of vision and the will to succeed can build one of these. Again, we only put small amounts of money in, but it's a small amount of money that makes it work. I think it was about 10,000. So just enough to just push
just the timing of it, actually.
Yeah.
I mean, because they needed to put it together very quickly initially, and it was just the ability to respond very quickly and put in a little bit of money that allowed them to go through with all the things. And then I think they've done very well.
Absolutely. We're kind of like a catalyst at times for just to enable people to do things. Unity House, another share issue in Wakefield, was a punk venue in the 80s, those of you who remember, but derelict now more or less. Wetherspoons, I think, have taken the basement level, but they're looking to reopen it as a venue, as a community share issue out of that one. Portland Works in Sheffield, Cutlery Factory, again another community share issue, business incubator units along the bottom, the people within they're looking at trying to buy the building. These are really ambitious projects, and anybody who thinks it's easy should just speak to these people, because it's really hard. But again, we should put small amounts in, just helps people to get the ball rolling. Just to show the other side of the scale, we've done some of these renewable energy hydro schemes. There's another one, Settle Hydro is one of the first ones we got involved with. Stockport and Whitby have been the most recent. Stockport, there are, without getting too technical, what these things rely on is an Archimedean screw generator. It's like a drill bit, and you put it in the water, and the water turns the drill bit. It's fish friendly, so to say. And at Stockport, they've put two of these big generators. Costs about, I think they cost about 350,000 a piece, 500,000 in total to develop. When we first started doing community share issues, we didn't think that we'd raise £100,000 from community share issues. Stockport raised 350, I think. Whitby raised 150. I'm not sure about Wally, but they've all done really, really well. The generator for Whitby goes in about a month's time. That will be the first one in a national park. So the North York Moors National Park is involved in that one. They put some of the money into it. Again, we've not done a great deal of finance, but just enough to make the thing tick over.
Watch out for Sheffield, Jordan's Dam. There's one, Saltaire. They've just got the planning to put one in at the weir at Saltaire. So if anyone's interested,
but it's all about, with these things, it's all about community engagement. The key to it is having a project that excites people, that gets people to part with some money. Small amounts of money can go a long way. Another one, just to show that you can do things in a different way. The big thing with somebody downstairs, when I was at one of the sessions downstairs, was asking why a community benefit society. These are all community benefit societies. It's a decision really about control. If you want to, as founders, want to stay in control of something, different format in terms of the way you need to operate it. If you're quite happy to throw it open to the members, Community Benefit Society in its purest form, with one member, one vote, is a great way of doing that. In this case, what you've got is a charity that wanted probably to take the best of both worlds, if you like, wanted the benefit of being able to raise the money through a Community Benefit Society, but also wanted to retain control as the founder. So what they did here was, the two charities came together, I think, to form a community interest company. The community interest company then launched a community share issue for a community benefit society. The community benefit society and the KIC then formed a partnership. So you've got money coming in through the community share issue, and you've got the control being retained by the two charities through the KIC. And the two then running under an NLP. This is a wind project. It's at Chatsworth, controversial, I guess, for some people in terms of putting these things into those kind of spaces. There is a race here because of the change to the feed-in tariffs. The 10% will knock the profit out of a lot of these things. So it remains to be seen. Other developments. There's always a problem with scale in social enterprise. You can usually get so far. There's a glass ceiling in terms of where you go. Risk capital is always an issue. Can't be wholly addressed by people like Key Funding. Needs some much bigger things to work there. CASA, Calderdale, Home Care Associates as part of the CASA group. It was a successful model in Sunderland. It's a home care model, caring for people in the home. They ran for any number of years, about 7 or 8 years, had a very successful model for doing it, wanted to replicate that model elsewhere. So what they did was they created a hub, which is like a company limited by guarantee, but operating under Cooperatives UK's, they have a structure for like a mutual company limited by guarantee. You can have members, but it's still a company limited by guarantee. They created the hub at the centre, and then round the edge, the spokes of other organisations similar to Sunderland Home Care. And then, so it's like it is a form of franchise, but not a conventional franchise. In a conventional franchise model, what you get is a business that's run very successfully, that wants to replicate itself, so it effectively helps other people to set up their own business in the umbrella of that branding and the model and how it works. And then in return for a fee, they can then run that model as their own business. And the intention here is to do pretty much the same thing, is to use the branding, the model, the framework, the financial structure, etc., for running a business as in the case of Sunderland Home Care, but in a totally separate company. So the other companies, in most of these cases, these are, by and large, just ordinary limited companies. But they have a certain amount of shareholding that's owned by the central structure, and a certain amount of the shares is owned by an employee benefit trust. So effectively, like the John Lewis model, you've got people who are employees owning a stake in the business. That ownership brings better care, better employee buy-in to the organisation's structure. And the idea then is to grow this thing. It now has 5 or 6 of these things, which it's grown in a couple of years, whereas it took them 7 or 8 years to build the first one. So it's managed to scale up using Bridges Ventures money and some of our own. But big opportunities for this in other spheres, and if you've got organisations that have a successful business model, then to replicate it elsewhere, there is an opportunity, a real opportunity. It's at the early stages, but quite exciting in terms of what it can do.
Sorry, Gary. I think that's quite an interesting one because Key Fund, they went quite a long way. Sunderland Home Care is a very well-known, award-winning thing. CASA was set up, Guy Turnbull involved in it. They needed some venture capital to expand. Key Fund put it in. They got picked up then by Bridges Ventures. They got big enough to be one of the social enterprise investors for Bridges Ventures. And so it's quite a nice example, I think, of the community development finance market working in tandem of us doing our bit and then passing on to the bigger venture capitalist funds.
Big issues with...
We've got about 10 minutes left, I think, for the whole thing, so we're good to get...
Yeah. The exciting thing about this is it does give an organisation a chance to achieve scale. The only thing I wanted to say about this is none of it is easy. It's really, really difficult. Make it sound easy, make it sound like you can throw money around and make things happen. It always is difficult. But one of the key things about this is really good governance. If you've got good governance, then people tend to pick up and be interested in investing. And so, although this is the hallmarks of an effective charity, I always put it up because I think it's a really good thing to have at the back of your mind is that you need really good governance to make these things work, particularly around finance and how you treat it. If you want to stay in touch with Key Fund, we've got a website, we do newsletters, sign up for the newsletter. All we do is tell stories about what we do. That's the application form, so it isn't daunting. That's it. You just fill it in and send it in. We've grant monies in Yorkshire and Humber, which make it slightly more attractive. We operate in the whole of North of England. We can help with business planning, with business templates and so on. We are in the throes of launching 2 mentoring programs, one for pre-starts, one for other organisations that are looking for finance for the first time or are struggling to get their heads around how their finance thing works. So we've 2 of those. One's completely free, and the other one is for a modest fee you can get involved with. We do all the FaceTube stuff, so if you can follow us on Twitter, etc. And that's it really.
Thank you very much to our 2 speakers. I've got about 10 minutes between now and going for tea and coffee, and the final plenary at the end. I don't know, should we just throw it open for questions and we'll try and get as many as we can in the next 10 minutes? I'm sure there's a lot of real technical stuff here, so I don't know whether people just want to kind of ask something specific, or we could see if there's any kind of themes.
Looking at that one with crowdfunding and investing, which is like loans up to 150k and all that, obviously the thing that puts small businesses off starting up is that repayment factor and penalties. How, if you're looking at social enterprises and investing in those, what are the, I suppose, the support mechanisms in place? What happens if they fail?
It's a good question, and it's the one that we always get asked. And people always worry about finance. But if you're a conventional business, finance is one of the tools that's at your disposal, and you quite readily use it. I think to ignore finance is to not use one of the tools that, and it puts you at a disadvantage. And I know where you're coming from. We will only lend to incorporated bodies, so we only lend to limited companies, people with limited liability. We don't hang the asset, we don't hang the debt around the neck of an individual, which is the first thing. So by and large, we don't take directors' guarantees. We will in certain circumstances, but only if there's benefit to the directors directly, as opposed to no benefit to the directors. And in those instances, you usually got someone owns the building, but they're running a social enterprise within it, and so we might take a guarantee because anything the social enterprise does to the building might benefit them directly. But they are absolutely the exception. What I say about debt finance is, if you've got an electricity bill that you want spread over 12 months, you've taken finance. If you want to pay your insurance bill over 12 months, you've taken finance. If you take on a lease for 2 to 3 years, you've taken on a heavier commitment than a £10,000 loan there would ever be. If you've employed people, the employment contracts are far more risky than a small-scale loan of £5,000 or £10,000. If you've taken on a lease, you've a commitment to meet rental payments. It's no different to taking on a loan. If you've taken on an employee, I would say the risk is even greater, because you've got someone there. If you don't pay them at the end of the day, then that springs back on you. So where I put the risk, because this is about your judgment on what you think about the risk element in this, it's you've got to get it balanced. Yeah. And so I'm not saying take loans, they're fantastic. I love people who are frightened to death of borrowing, because those are the best people to deal with. But you know, at the end of the day, it's about getting a balance between the kinds of risk that's involved.
I think I was looking more at it on the comeback forum, because things do fail, it does happen, and it's an occurrence. Now for yourself, you've got to do your own risk management on finances. It was more, with it being a social enterprise, if you were looking at it as a social enterprise.
Well, what I always say on that is we're not a soft touch, no, but we are a light touch organisation. So if you are struggling, we'll work with you to sort it out. You know, we can do all sorts of stuff to try and work it through, if you've got the commitment to see it through. And if you're battling to create something that we think we have invested in, that we think is worthwhile, we'll work with you to save it.
But we've got to be a path back to the ones like, you know, the repayable grant schemes that were, seem to have rapidly diminished at the moment.
I doubt.
That seems to take a lot of the risk and pressure off people and are more willing to move forward.
Yeah, as I say, we're a lender at the end of the day, so primarily the grant side of things. Like I say, if you're looking at social enterprise earns its money from trade and pays its employees. So if you take a volunteer, that's not pure social enterprise, because it's effectively a grant. You know, that person is giving you their time. So in terms of what we're promoting in investing in social enterprise is earning your money from trade, paying your employees. That's the ideal. And yeah, there are risks.
This gentleman, the lady at the front.
You put up my application form and said, oh yeah, it's nice simple application form, but as ever, the work is all before you get to the application form, isn't it?
Well, yeah.
And what struck me is that you're putting up such a lot of interesting structures for organisations. Are there ways in which the Key Fund or other organisations would, because some of those models, and that complicated one about the wind power people, I say, oh wow, yes. Where would you access information about potential structures? Because obviously your fairly standard advice is very limited on those structures.
It's non-existent.
Yeah, exactly.
No, that's why we've stepped into into this arena, because we were given names of people to go and see that are doing these things, and the advice coming back was frankly pretty poor. So we've kind of put our money where our mouth is and sort of stepped forward and said, okay, we'll start doing some of this stuff. So we've a scheme for helping people at the feasibility study stage, if you like, which we're doing through. There's a national programme that the NEM's running for start-up businesses in general, which covers conventional businesses. And Key Fund has the contract with, through the Regional Growth Fund, through the NEM. It's a Barclays sponsored scheme as well. We've got, which is funny, but I'll tell you about that. But we've got the contract for the whole of Yorkshire and Humber. So, well, just ask.
Right, okay.
We don't have the contract for that, but
yeah.
What I'd say though in terms of structure is, form follows function. Decide what you want to do, and then come and ask about, work out what stage you're at, the right kind of money. Some forms, if you want to do community share issue, you have to go for an IPS BENCOM. It's the only, well, you don't. You could do a public offering, but it will cost you £60,000 or £70,000 in lawyers' fees to structure it. So for most purposes, the only form that currently has the exemption from that heavy regulation is the IPS. Although some of Nesta's stuff around venture crowdfunding is, I think, dangerously close to illegality, but it is going on.
There's a gentleman over here as well who's wanting a question. I think then we're just about done as well.
Yeah, I work for an organisation that is essentially a social enterprise. But we did practice this earlier. We've just got a £50,000 loan from the Key Fund. And just a couple of comments really. From the first meeting we had with Gary to get to the offer letter was a month. And I find that frankly astonishing, given that we've been talking to other people. On the positive side, astonishing. Right? And there's all the usual conditions attached to it, as you would expect, because it is a social enterprise, it's going to generate money and so on. But it's the flexibility and the speed which was really very, very positive. I have another question.
We have monthly panels on the last Friday of the month, so you obviously hit the purple patch. In terms of
you mentioned in passing, both of you, the Big Society Bank.
Yeah, Big Society Capital. Yeah.
As I understand it, that's not, it itself isn't going to give out money, it's going to passport it to other organisations which will will that have a big effect? I mean, it's about £600 million.
I should declare an interest. I'm on the advisory board of Big Society Capital. I think it will. It's clearly going to increase the supply. We had an advisory group meeting earlier this week. They've had a fairly good initial response. They think they're going to commit between 50 and 70 million pounds to these intermediaries. So think of it like the Bank of England for the community development financing. They are aiming at a low single-digit return, is what Nick calls it. So 4 to 6% they need to earn on their money over the 10-year period that they have the mandate to do it. So they're not going to produce cheap money. And to some extent, I don't think they're going to produce money that is going to flow into the high risk space that I think is still lacking funding. So it's an important new source of funding. A lot of the CDFIs, a lot of the intermediaries themselves are too small, they're too vulnerable, they're not very quick at giving decisions. So I think it is going to, a bit like quantitative easing, if you like, is the Bank of England's current system to take some of the pain out of the conventional banking system. I think big society capital is going to flow through the community development finance market. I think what's interesting is the work they're doing around setting up new funds, and they're very keen on introducing new entrants for the market. So where they will give money, we hope, to Key Fund and Charity Bank, and they've put some money through Triodos, they've done a sort of mini social investment bond in Liverpool around. So, but the Outcomes Fund, I think, you know, for me this is the future, talking to my local authority colleagues. There is no money, the cuts are only a quarter or a third of the way through a programme. You can't get a contract out of local authorities. Except they are aware that in order to continue to cut, they're going to have to transform the way they deliver services. So I think, you know, the game in town is outcomes-based contracts, performance by results contracts, where you go in and say, I'm working with an organisation in Bradford who do interventions with bad lads. They're talking to the youth offending team about getting contracts out of them, saying, if we reduce the costs of these particular cohorts of kids to you across the piece, will you give us a contract? We don't want any payment for 2 or 3 years. And then aligning something like Key Fund or other social finance things that will fund the working capital requirement for those 2 or 3 years. So I think that's the direction of travel in terms of, particularly in terms of, you know, third sector public contracting. And we're going to have to continue to do those kind of deals. And so the risk money needs to be aligned with the delivery capability then. Because obviously we're not going to provide 2 years working capital to an organisation we don't believe is not going to deliver on those outcomes.
That seems like a fairly good place to leave it. I would think, because I think that's true as a local authority person. This is all